In a bid to fight the 40-year high US inflation, the Federal Reserve hiked interest rates by 75 basis points on Wednesday. The decision, which was unanimous, took the target range for the benchmark federal funds rate from 3% to 3.25%, the highest level since before the 2008 financial crisis and up from near zero at the start of this year. After the third straight big rate hike, the hawkish US Fed signaled to reach 4.6% by 2023, until inflation retreated to 2% objective. As the US Fed signaled additional monetary tightening down the path, the 10-year US Treasury yields jumped to a 15-year high of 4.1%. US dollar index also raced to hit a fresh 20-year high of 111.4. Moreover, even though gold is regarded as a hedge against inflation, rate hikes usually raise the cost of owning bullion, which pays no interest. On MCX, prices of spot gold have fallen 8% from March peak to 49,491 rupees per 10 grams. Globally too, prices of spot gold have trimmed 18% to $1,664 per ounce from over $2,000 per ounce recorded in March. Analysts believe that the demand for a safe haven asset is shifting to bonds as yields climb to decade high. Going ahead, the pressure is likely to continue on the yellow metal until inflation peaks out.
COMEX gold prices fell to near a 2-year low and dollar surged to a record level after Federal Reserve's hawkish comment. The metal is on a cusp of sinking into the bear market. During the recessionary and high interest rate period, investors prefer stable return and invest in a bond. Haven demand has been shifted to a bond as yield surges to a decade high, and going ahead, looking at the Federal Reserve's commentary, the rate market remains on a higher side, which will discourage the demand for the gold. Gold will remain vulnerable to selling pressure if inflation does not continue to rise. In the near term, spot COMEX gold is having support around $1,650 an ounce, and breaking of the same will lead to escalations of selling, and we could see a level of 1600 and more, while on a resistance front, $1,732 an ounce will act as a near-term resistance. Back home, spot gold prices could find support somewhere around 14,500 per 10 gram ahead of the festive season. The weaker rupee and physical demand will continue to help the limiting the loss in the gold, while the weaker international gold prices to weigh on the domestic prices. In the short term, MCX gold remains on a bearish side as long as it trades below 52,500 per 10 gram.
Further, analysts also believe that though dollar appreciation would put pressure on gold prices globally, rupee's depreciation may spark interest in domestic gold.
Since the Fed chief has indicated that the terminal rate is likely to be 4.6%, more rate hikes can be expected this year and early next year. Under such a scenario, dollar index is likely to remain resilient. Gold prices and dollar value are inversely related. Since gold price is expressed in dollars, gold price can be expected to further soften since dollar is appreciating. The short-term outlook for gold is bearish. In India, rupee depreciation will impart some strength to gold, but this is likely to be short-lived. Investors may look at buying gold only after the dollar index shows signs of peaking out.
That said, according to the World Gold Council, an outright recessionary environment or stagflation could offset pressure from the yellow metal. Further, it also expects increased trading volumes amid a pickup in consumer demand to support the metal in the near term. As regards today, FII flows, rupee movement and crude oil prices will continue to guide domestic markets. Besides, investors will also closely track the UK and Eurozone's factory and services data.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.